wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you up to date with the latest developments in the financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 167. And in this episode, we are reviewing the performance of the global markets during the 27th week of 2025, and that is from Monday the 30th of June to Friday the 4th of July. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off with a global overview where, according to the World Bank's latest Global Economic Prospects report, the global economy is projected to grow at 2.3% in 2025, which is lower than the growth rate of 2.7% that was recorded in 2024. This forecast marks a slight downward revision from the earlier projection of 2.7% in January, reflecting anticipated economic slowdown, particularly due to rising trade disputes and policy uncertainties. The World Bank's growth projection is 0.5 percentage points lower than the IMF forecast of 2.8%, which was also revised downwards from a projected growth of 3.3% in January 2025. Both the World Bank and the IMF have revised their projections for global economic growth in 2025, and this is mainly due to weakening global trade that is largely driven by U.S. trade tariffs, which have disrupted global supply chains and slowed down cross-border economic activity. Over to the United States, where the growth in employment proved to be better than expected in the month of June, surprisingly boosted by government hiring, as the labor market showed resilience and reduced the probability that the Federal Reserve will cut interest rates at its next policy meeting in July. On Thursday, the Bureau of Labor Statistics reported that nonfarm payrolls, which measures the total number of new jobs created in the U.S. economy to the exclusion of the agricultural sector, this increased by a seasonally adjusted 147,000 new jobs in June, which was higher than the forecast number of 110,000 jobs and was slightly above the upwardly revised number of 144,000 jobs that were created in the previous month of May. Meanwhile, the unemployment rate fell to 4.1%, which was the lowest rate since February 2025 and was much lower than the forecast rate of 4.3%. However, a more encompassing rate of unemployment, which includes discouraged workers plus those holding part-time positions for economic reasons, this rate edged lower to 7.7%. Staying stateside, on Tuesday, the Federal Reserve Chairman Jerome Powell said that the U.S. Central Bank would have eased monetary policy by now if not for President Trump's tariff policy. Powell was speaking at the European Central Bank's forum in central Portugal, where he said that the Fed went on hold when they saw the size of the proposed tariffs, and as a consequence, the inflation forecast for the United States has increased significantly. The Fed has entered a holding period on interest rates, and this is despite mounting pressure from President Trump to cut interest rates. Over to the Eurozone, where according to flash data that was released by Eurostat on Tuesday, Eurozone inflation rose slightly to 2% flat in the month of June, meaning that consumer prices in the trading bloc are now in line with the European Central Bank's target rate of 2%. The inflation reading for June came out in line with economists' expectations after having fallen to 1.9% in the previous month of May. Meanwhile, core inflation, which excludes volatile food and energy prices, this remained unchanged at 2.3%, as the closely watched services inflation rate picked up to 3.3% in June. On Wall Street this past week, U.S. stocks rose on Thursday, with the S&P 500 and the Nasdaq Composite hitting fresh record highs following the release of a better-than-expected jobs report for the month of June, which fueled optimism that the U.S. economy remains resilient despite Trump's inconsistent trade policies and escalating geopolitical tensions. The strong jobs report also spurred a spike in Treasury yields and reduced expectations that the Federal Reserve would cut interest rates anytime soon. As mentioned earlier, both the S&P 500 and the Nasdaq Composite closed at record highs, with the broad market index ticking up by 0.83% to close the day at 6,279, whilst the tech-heavy Nasdaq Composite gained by 1.02% to close the session at 20,601. And last but not least, the Dow Jones Industrial Average advanced by 344 points to end the week at 44,828. In the government bond market, the yield on the benchmark 10-year Treasury bond rose sharply on Thursday following the release of the employment report for the month of June, which came out hotter than anticipated. The strong jobs report ignited a spike in Treasury yields and reduced the expectation that the Federal Reserve would cut interest rates in July. According to the CME's FedWatch tool, futures traders are currently pricing in about a 95% chance that the Federal Reserve will hold interest rates steady at its next policy meeting later this month. The yield on the benchmark 10-year Treasury bond rose by more than 5 basis points to settle at 4.34%, whilst the yield on the 2-year Treasury note advanced by more than 9 basis points to close at 3.88%. For your information, bond yields move inversely to bond prices, and 1 basis point is equal to 0.01%. In the foreign exchange market, on Thursday, the dollar advanced against other major currencies such as the Japanese yen, the euro, and the Swiss franc, and this was after data showed that the U.S. economy created more jobs than analysts had estimated, signaling that the Federal Reserve might take longer to cut interest rates. The appreciation of the greenback was accompanied by a rise in U.S. Treasury yields as the dollar strengthened by 0.7% to 144.78 to the Japanese yen and was up by 0.6% at 0.797 against the Swiss franc, and against the euro, the greenback rose by 0.47% to trade at $1.1743 to the euro. In the crude oil market, The price of oil dipped slightly on Friday as the possibility of U.S. tariffs being reinstated raised questions about demand ahead of an expected supply boost by OPEC. Tariff uncertainty looms large, with the 90-day pause on the implementation of U.S. tariffs ending on Wednesday, the 9th of July, and as yet several trading partners, including the European Union and Japan, have yet to clinch trade deals with the United States. In addition to that, the Organization of Petroleum Exporting Countries, which was scheduled to have its policy meeting this weekend, is expected to raise oil output by 411,000 barrels per day. In response, the price of the global benchmark Brent crude fell by 68 cents to trade at $68.43 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this declined by 84 cents to close at $66.61 per barrel. In the precious metals market, the price of gold edged up on Friday and was poised for a weekly gain as President Trump's tax cut and spending bill passed through Congress and was signed into law on Friday. According to the nonpartisan Congressional Budget Office, this legislation is projected to add about $3.4 trillion to the U.S. national debt over the next 10 years. This is raising concerns as the U.S. national debt is now approaching $37 trillion. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. In response, the price of spot gold rose by 1.7% this past week and was last seen trading at $3,329 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at economic growth, where according to a report from the Kenya National Bureau of Statistics, the Kenyan economy recorded a growth of 4.9% in the first quarter of 2025, which was the same growth rate that was recorded in the first quarter of 2024. Meanwhile, agriculture remains a main contributor to Kenya's growth, and this sector grew by 6% in the first quarter of 2025, which was higher than the expansion of 5.6% that was recorded in the first quarter of 2024. And on the cost of living, as measured by the overall rate of inflation, this remained stable at 3.8% in the month of June, maintaining the same rate that was recorded in the month of May. The headline rate of inflation was mainly driven by a modest increase in food prices, as well as transport and housing costs. Core inflation, which excludes food and energy prices, this increased to 3% in June compared to 2.8% in May. The current rate of inflation remains within the central bank's target range of between 2.5% and 7.5% and could be an indicator for a further reduction in the central bank rate at its next policy meeting. In the domestic foreign exchange market, during the past week, the Kenya shilling remained stable versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24 compared to 129.29 that was recorded the previous week. Meanwhile, the sterling pound was priced at 175.69 and the euro was valued at 152.06. And on the regional front, one Kenyan shilling was changing hands for 27.75 Ugandan shillings and 20.43 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.11. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves were stable compared to the previous week, with the reserves recorded at $11.09 billion, which is equivalent to 4.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.67% compared to 9.73% the previous week, but was still pretty much in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 5.5 billion shillings compared to just 490 million shillings the previous week. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 3rd of July, and the central bank received bids totaling to 21.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 91%. The central bank ended up accepting almost the entire amount of 21.7 billion shillings, and the results of the auction were as follows. The 91-day rate ticked up by less than 1 basis point to average out at 8.14%, whilst the 182-day rate took a slight dip to settle at 8.45%, and the 364-day rate was a shade lower at a weighted average rate of 9.71%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the July bond issue, in which it is looking to raise a total of 50 billion shillings through the sale of 2 reopened fixed coupon treasury bonds whose terms and conditions are as follows. The first bond is a 20-year bond with 12.8 years left to maturity and a coupon rate at 13.20%. The second bond is a 25-year bond with 18 years left to maturity and a coupon rate at 10% flat. Please note that these bonds are now open for sale until Wednesday, the 9th of July, when the auction will be held. At the Nairobi Securities Exchange, during the second quarter of 2025, the equities market was on an upward trajectory, with the NASI gaining the most by 17.3%, whilst the NSE 20 recorded a modest but decent increase of 9.6%. This takes the performance for the first half of 2025 to gains of 22.4% for the NASI, 18.5% for the NSE 20, 14.3% for the NSE 10, and 13.9% for the NSE 25. The market's performance during the second quarter was driven by gains recorded by large cap stocks such as Safaricom, which increased by 36.6%, whilst NCBA Bank and Cooperative Bank increased by 13.3% and 11.9% respectively. These gains were, however, weighed down by losses recorded by other large cap stocks such as Bamburi Cement and British American Tobacco, which declined by 4.4% and 2.8% respectively. Up next is our topical issue, and this week we're looking at a report from the United Nations on Kenya's debt servicing costs. A United Nations agency has flagged Kenya's elevated expenditure on debt interest payments, which it said was constraining the country's ability to fund critical services such as education and healthcare. The United Nations Conference on Trade and Development has listed Kenya among countries with the largest share of net revenues going to service its national debt, which is a clear indicator that the country's debt is approaching unsustainable levels. An analysis by the UN agency shows that in 2024, Kenya spent nearly 30% of net revenues to pay interest on both domestic and foreign debt. The analysis shows that Kenya's interest repayments gobbled up about 29% of its total revenues in 2024, ranking the country amongst those with the highest risk in terms of the percentage of total revenues being used to service its national debt. Disclosures by the National Treasury confirm this trend and show that in the fiscal year ended June 2024, interest payments on public debt stood at about 841 billion shillings, accounting for about 31% of total revenues, which came in at 2.7 trillion shillings. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. And just for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhurij@gmail.com, Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, if you know what you want to do and you believe in yourself enough, you will achieve your dreams. Think about it. Thank you, and God bless.